Hey, I'm Chris from Fingster. I'm here to help you stay on the right side of this AI-driven change. We've taught over 20 million people in AI and tech in the last 10 years. Okay, so let's dive right into the video. We are going to look at the Finviz screener, and I use different AI agents to figure out the best filter, Finviz screener, to screen for recession-resistant stocks. And this is not financial advice, this is just what I came up with after extensive research of multiple agents. I used ChatGPT agent, of course. I used the Gemini agent, and I also used different other agents, for instance from Anthropic model. And what I compiled with, so I found the best answer was given by ChatGPT. And so let's dive into the best screener for recession-proof stocks. Okay, so first go to finviz.com/screener. You can also type in Finviz screener. I'm not affiliated with them. I think it's just a great website to do these kind of things. Okay, and if you like this kind of content, then please give me a like and subscribe to the video. This really helps the algorithm. Okay, so let's dive into the screener. First of all, we are going to go into the descriptive tab and click on Dividend Yield and use like at least positive, or at least like ChatGPT actually says over 1%. So why is that? I'm not a huge fan of dividend yield. I think many businesses, also recession-proof businesses, can compound their own balance sheet by more than say the S&P 500 return. So, and if this is the case, if you really have a recession-proof stock that can compound money faster than S&P 500, then usually it's rational to keep the money in the system. But that being said, I mean, this is what ChatGPT recommends, and it definitely goes like screens out the much more conservative businesses. For instance, I believe Apple also has a recent dividend yield, and Apple, I would say, is objectively more conservative than, say, Tesla or other growth stock. This doesn't mean that I don't like the Tesla stock and the Tesla story. I like it, but I think it's just more conservative. And ChatGPT argues that why include dividends? Dividend-paying stocks have historically cushioned portfolios in recessions. And there is actually some research by Morningstar that found that dividend-paying stocks outperformed the market in 3 of the past 4 recessionary periods. Okay, next one will be in the fundamental session. We are going to look at the low debt to equity ratio. So let's go to the right. Where is it? Debt to equity. I think maybe I need to, here. So here we have debt to equity. We have long-term debt to equity and just a normal debt to equity. And ChatGPT wants to have it smaller than 1. Why is that? So why under 1? The reason for this is that research from MIT's Sloan School shows that companies that took on heavy debt before the 2007-9 recession, and this was like the mother of all recessions, were forced to cut employment and scale back investments. And like firms with healthier balance sheets, so if you divide the outstanding debt divided by the equity, if it is smaller than 1, this means that you have a relatively small debt number compared to the equity you actually have. So it's like very conservative way. It's not so leveraged on the way up, but if you expect like some way down, then obviously you can focus on low debt to equity stocks. And there was some research by MIT showing that this is actually less risky. Okay, then something else. I think it's like more, I don't generally think that technical analysis is the way to go, but certainly there's some wisdom in the market. And if you have like a beta of under 1, then according to Alliance Bernstein's research on low risk anomaly found that least volatile quintile of global stocks has delivered return 1/3 higher than the market since 1973, with about 20% less volatility. So it's basically an outperformance that was shown. And we can simply set beta to smaller 1 to identify stocks that historically move less than the market. So they have less volatility, these stocks, and consequently are more recession-proof, or could be considered as more recession-proof. Okay, then we have one last screener. It's a very simple screener. And this is about again, a fundamental metric, high return on equity. So you can't pump up return on equity by just taking on a lot of leverage, right? So if you have only like if you finance a house with some real estate purchase or so, you only have 10% equity and 90% debt financing. Then the house appreciates by 10%. Now you actually have 100% return on equity. So you have a relatively high return on equity. But we already screened out companies that have a lot of debt, right, in the previous screen. So this simply shows that we have very, very healthy businesses, and we should set this to like 10% or more. And yeah, with these kind of 4 screens, dividend yield greater than 1%, low debt to equity, preferably smaller than 1, low beta smaller than 1, so less volatility than the market. This is what it means. And high return on equity, like larger than 10%. Combining those would yield the like most attractive companies that you can then start your screening work on, right? For instance, here's one company, AllianceBernstein Holding. It's an asset management company. You see there are many like financial companies in the screener, and now you could go into like valuation, for instance, which is something that I would do, and sort by, or maybe just sort by market cap, right? So we don't even go that much into like the valuation in terms of is it expensive or not. We want to have defensive companies, right? So sorting by market cap would be a reasonable thing to do. And now you can see Johnson & Johnson would meet this criteria. I think most would agree, like this Warren Buffett style stock in drug manufacturing would be very defensive, right? Then we have ExxonMobil, we have Procter & Gamble, Cisco Systems, United Health, like this is the first one I don't know, and Merck. So you see these kind of very defensive companies would actually make the screener. Okay, so that's it. That's a screener. I think it's very useful in times like this. I mean, these stocks would also, in my opinion, be attractive picks in a non-recessionary period. So if there's kind of a boom market, then obviously you have like other companies that would outperform those stocks. But I think in uncertain times like these, it might be interesting to look into these recessionary picks. No financial advice. This is a screener that was determined by extensive research, also analyzing many research papers to find companies that perform better than the market in recessions. This doesn't mean that these companies cannot like reduce in market cap or price or go down, but yeah, it just means that the likelihood, the relative growth would be higher in recessionary period. Okay, thanks for watching, and yeah, if you like these insights, if you want to be on the right side of change, then go to blog.finviz.com/AI. You can join my free email newsletter. We have 130,000 readers already. It's free. Like I send you regular emails, some like in periods, daily, sometimes if less is going on, maybe not daily. You can also check out my community, like expert builder community SHIP, where we like builders like me and others from the Finviz community go together. We share our goals, find accountability partners, and yeah, we are a group of calm builders. We use AI to ship useful projects every day. We are not like very heavy on coding, like I am, but not all group members are very heavy on coding. But with AI, you actually don't need to be a great coder. You can just like use natural language programming, literally use your words to write applications. And if you can imagine it, there's a chance you can build it as well with AI. Good. Again, please give me a like and subscribe, and thank you for watching. See you in the next video. Bye.